Jash Bhatia and this is my report for Fin223. It required me to create a globally diversified portfolio of 20 equities spread across NSE, Nasdaq, ASX, etc. This included various asset classes, areas, and sectors ranging from rapidly growing technology to stable energy and finance. Question 2 examined UAE's IPOs on comparison to developed markets, whereas question 3 assessed Nifty 50 futures for momentum strategies. I've come to obtain how investors obtain equities, REITs, convertible bonds, and derivatives on worldwide exchanges. Second, assessment of risk return. I computed CAPM betas for each of the 20 stocks using the formula, which RM represented the equal weighted market proxy. The findings indicated Tesla's beta 2.93 and Adani's 2.03 as high beta growths, while BP and Shell were identified as defensive low beta stocks. Sharpe ratios assessed risk-adjusted returns, equally weight 0.85 compared to tangency 1.12. Question 3 measured anomalies, January and Monday being minus 1.12 and minus 0.15% momentum, plus 0.28 versus constraint of plus 0.15%. I excelled in return computation and testing for statistical significance. The application of modern portfolio theory. Question 1 provided practical experience in mean variance optimization by utilizing 5,000 arbitrary portfolios derived from the 20 stock covariance matrix. 1 mapped out the efficient frontier and pinpointed the tangency portfolio, which is 16.2% return, 15.8% volatility, and Sharpe of 1.12. This demonstrated that PMT is effective. The diversification lowered risk from 18.2% to 15.8% at increased returns. Fourth, pricing of fixed income and bonds. Although not primarily, the UAE IPO analysis considered Gulf Navigation's dirhams 500 million mandatory convertible bonds, hybrid instruments combining debt returns with equity potentials of ALEX 7.1% dividend yield acted similarly to fixed income. The REIT analysis for question 2 focused on NAV-based pricing analogs to bonds valuation. This linked equity analysis with fixed income trades. Fifth, investment firms and performance assessment. My equity research reports reflects the work of professional fund managers. The hold, moderate buy suggestion for question 1, along with the quarterly rebalancing replicates mutual fund portfolio management practices. Question 3's 20% momentum satellite plus 80% Nifty EFT core allocation illustrates how active managers apply strategies over passive benchmark. 6. Behavioral finance and cognitive biases. Question 3 was a masterclass in behavioral finance. January effect being minus 1.12%, where tax loss selling leads to oversupply even with the absence of small cap bias in Nifty 50. Monday effect, negative news over the weekend plus disposition effect. Momentum, which was plus 0.28%, insufficient response, crowd behavior, reinforcement cycles, etc. These clarify why EMH is inadequate in the short term yet remains valid in the long term. Client recommendations weighted exploitable biases against anomalies eroded by average. Main point, this test converted theory into application. I chose stocks through top-down and bottom-down evaluation, measured risk-return using CAPM, Sharpe ratio, and efficient frontier, utilized PMT for ideal distribution, evaluated IPOs in various markets, examined EM through behavioral perspectives, provided expert suggestions. Abilities acquired, building a portfolio which is of 20 international stocks, risk indicators which was beta 1.02, Sharpe 1.12, optimization, testing for market anomalies, application of behavioral finance, reporting that meets industry standards. These equip me for positions in equity research, portfolio management, or quantitative trading. Thank you so much, guys.